Welcome back to the Deep Dive, where we take complex source material and provide you with the essential insights you need to be truly well-informed.
And today, wow, we are stepping right into the heart of probably the most famous economic battle of 20th century Britain.
It's a true clash of titans, isn't it?
Hmm,
It pits this incredible intellectual foresight against a very, very powerful political convention.
it really is. This is such a pivotal moment in macroeconomic history happening exactly a century ago. In our last deep dive, we set the stage by looking at Keynes's tract on monetary reform.
Right, from 1923.
Exactly. And in that, he was just vehemently arguing, warning against returning to the gold standard.
He warned against it. He said, don't do it. And he definitely said, don't do it at the pre-war parity, which was just, ridiculously high.
And now, here we are in 1925, and that warning has been, well, completely ignored.
Completely. Winston Churchill, who's the Chancellor of the Exchequer at this point, makes this fateful decision. He pegs the British pound sterling back to gold at that hallowed but completely outdated rate of $4.86.
And this wasn't just, a simple policy mistake in Keynes' eyes. It was an economic declaration of war on Britain's entire industrial base.
That's a strong way to put it.
It is. So our mission today is to do a deep dive into Keynes' scathing, immediate, and ultimately prophetic response.
His essay, The Economic Consequences of Mr. Churchill.
The very one.
Right.
Published almost immediately after the decision was made, we're going to unpack his rigorous economic argument, showing that this decision was, in his words, a dangerous and unnecessary path that would lead directly to, well, unprecedented industrial strife.
Okay, let's unpack this scene because it is so dramatic. You have Churchill, this formidable politician, making a massive financial decision, and then you have Keynes, the intellectual giant who is just utterly furious. So let's start with section 1, the motive. Why? Why did Churchill, who was famously adaptable, choose this financially orthodox but ultimately disastrous path?
Well, the thing Keynes argues, and this is crucial, is that Churchill wasn't acting from some deep personal conviction about monetary theory.
He wasn't an economist, after all.
Not at all. Keynes says, and this is a direct quote, he was gravely misled by his experts and the clamorous voices of conventional finance.
Ah, so it's a case of him listening to the wrong people.
It's a crucial distinction, yeah. It's not that Churchill was being foolish. It's that he lacked what Keynes called the instinctive judgment that you need to navigate these treacherous waters of post-war macroeconomics.
That phrase, lacking instinctive judgment, is fascinating. It suggests Churchill was just deferring to these authority figures who were deeply committed to an ideology rather than looking at the actual reality of the 1920s economy.
Exactly. And you asked who these clamorous voices were. They were primarily the city fathers, the banking elite, the financial institutions of the City of London. For them, that 486 rate wasn't just a number.
It was a symbol.
It was a symbol of Britain's lost financial prestige. Before the war, the pound sterling was the world's reserve currency, and its value, fixed at 486, was this immutable fact of life. So restoring that specific rate was about satisfying the impatience of this really powerful elite to, turn back the clock and restore the pre-war financial order.
So it was a nostalgic act, almost.
Yeah.
A symbolic act driven by this desire for international reputation.
That's it. It wasn't about stabilizing domestic conditions or, tackling unemployment, which is already a huge problem.
It was about prestige. Projecting strength on the world stage, even if the foundations at home were basically crumbling.
Precisely. They were sacrificing the real economy, the manufacturers, the miners, the laborers, on the altar of monetary reputation.
And Keynes points out that the Treasury and the Bank of England had already been sort of managing the currency to slowly inch it towards that 486 number.
Yes, and Churchill just decided to jump the final gap. He just committed Britain to this rate without any realistic or frankly humane strategy for how the internal economic adjustments could possibly be achieved.
So he committed the country to a hard number based on this historical loyalty and just ignored the painful fact that Britain's costs and prices had fundamentally changed since 1914.
He did. He believed the gap between the actual value of sterling and that 486 number was negligible.
Just a small matter of finishing the job.
Yes. And as we're about to see, that belief was based on looking at a completely wrong set of economic data. Keynes makes it brutally clear. Churchill set Britain on this disastrous course because he fundamentally misunderstood the sheer size of the problem he was creating. He was, in Keynes' view, just blindly accepting the dogma that returning to gold at the old rate was the only respectable thing for a great power to do.
Okay, so the stage is set for this huge conflict. Churchill's acted, the city's happy for a moment, but now the real economy is facing the consequences. This takes us right into Section 2, the overvalued pound, and what Keynes called the 10% calculation.
Yes.
This is the core economic trap, and I think we really need to spend some time breaking down the mechanics of it.
Absolutely. This calculation is the intellectual weapon Keynes just uses to demolish the entire policy. So when the decision was announced in 1925, the actual market value of the pound, its purchasing power on foreign exchanges, was roughly 10% below that pre-war 486 parity. So by legislative decree, Churchill instantaneously raised the value of the pound by 10% relative to other gold-backed currencies like the US dollar.
So Britain decides its currency is worth 10% more overnight.
Yeah.
What is the immediate, unavoidable economic consequence of artificially jacking up the price of your own currency like that?
It creates a catastrophic condition for the whole productive side of the economy. Keynes called it the export price squeeze.
Export price squeeze.
Yeah. I mean, think about it from the perspective of a British manufacturer. You're selling coal or textiles or machinery abroad.
Right.
Now that the pound is suddenly worth 10% more, the whole transaction has to adjust.
Okay, so the foreign buyer, let's say they're in America, they now have to find 10% more of their own currency, so more dollars, to purchase the same amount of sterling to buy your goods.
Exactly. Keynes spells out the unavoidable consequence. Whenever Britain sells anything abroad, the foreign buyer has to pay 10% more in his own money. Now, if that foreign buyer is unwilling to pay that 10% price hike,
And in a competitive global market, why would they?
they absolutely wouldn't. So if they won't pay it, the British seller has to be the one to absorb the difference.
Which means the British seller has to accept 10% less in sterling for the exact same goods they sold yesterday.
That's the squeeze. The British export industries, and Keynes specifically points to the heavy industries of the time. Coal, iron, steel, engineering, shipping freights. They are forced to reduce their sterling prices by 10% just to maintain the exact same competitive position they had the day before Churchill's announcement.
Since the policy immediately involves a reduction of 10% in the sterling receipts of our export industries.
Instantly. And this isn't just some, theoretical loss on paper. This is a revenue reality that hits your bottom line like a ton of bricks.
And if your revenue from sales just drops by 10%, you are suddenly facing a monumental deficit, unless you can somehow perform a corresponding miracle on your costs.
Precisely. And that is the absolute heart of the dilemma. The export industries could only afford that 10% price cut, the sudden loss of revenue, if and only if their internal costs also fell by 10% at the exact same time.
We're talking wages, transport, local taxes, everything.
Everything. If every single cost fell by 10%, the moment revenue fell by 10%, the industry would be, no worse off. It would be exactly where it was before.
But of course, in any real economy, that kind of generalized simultaneous fall in costs just doesn't happen automatically.
No, of course not. Costs, and especially wages, are sticky.
They're sticky.
Incredibly sticky. Wages are set by contracts, by inertia, by collective bargaining. Domestic transport costs rely on rails and domestic labor, which haven't seen any immediate deflation. So because these internal costs haven't fallen, the export industries, the engines of the whole British economy, are immediately reduced to what Keynes calls a bankrupt condition.
Wow.
Churchill's policy of improving the exchange by 10% was, in essence, a policy of reducing everyone's wages by 2s in the pound.
A mandatory 10% pay cut for the entire country.
That's what it amounted to.
That phrase just lays it bare, doesn't it? It's an immediate mandatory transfer of burden onto the productive economy. But if the costs don't fall, how long can these vital industries even operate while they're hemorrhaging 10% of their revenue?
They can't. And this is why Keynes predicted industrial strife immediately. The decision committed the country to deflation. And that necessary deflation, that generalized fall in all internal prices and wages, had to be implemented somehow.
The government, by setting the external value of the pound so high, had basically issued a mandate for the Bank of England to force down the internal value of all goods and labor.
It's an enforced austerity, all driven by a currency target. But this whole argument, it really hinges on the fact that the disparity was 10%. If it was, say, 2 or 3%, the adjustment would have been painful, but maybe manageable.
Right. And that brings us to Section 3, which is just crucial. Why Churchill's advisors got this so wrong, why they missed this massive economic trap, the fundamental disequilibrium, and this catastrophic data error.
This is maybe the most devastating part of his indictment of the conventional wisdom of the time. Keynes explains that the return to gold greatly aggravated an existing fundamental disparity between Britain's internal cost structure, what it cost to live and work and make things in Britain, and the external value of sterling.
And this disparity was being masked because they were looking at the wrong numbers.
Completely missed. So the question is, what numbers did the experts, specifically the Treasury Committee on the Currency, what did they focus on, and why did those numbers mislead them so badly?
Okay, so what were they looking at?
They were focused heavily on the wholesale price indexes.
Right.
Now,
Yeah.
these indexes, they track the prices of large volumes of raw materials and commodities, things like wheat, copper, rubber, and crucially, raw cotton being traded in places like Liverpool.
And these are all internationally traded goods.
Exactly. And Keynes points out that because these materials are internationally traded, their prices adjust to foreign exchanges almost hour by hour.
So, if the government slowly nudges the exchange rate up towards 486, the price of raw cotton in Liverpool, which is bought and sold globally, will instantly adjust to that new exchange rate.
Precisely. And since these wholesale price indexes are often made up of, 2/3 or more of these internationally traded raw materials, they appear to reflect the new external currency value almost perfectly. So when the experts looked at the wholesale index, they concluded that the British economy was already mostly in line.
They thought the gap was tiny.
They believed the remaining gap to be bridged was negligible, maybe only 2 or 3%.
They saw the reflection in the commodities market and just believed the whole house was in order. But that doesn't account for all the domestic sticky costs, does it?
It accounts for none of it. Keynes says the true indicators of the economy's internal cost structure, the things that don't move minute by minute with the currency markets, were things like the cost of living index, the general level of wages, and the prices of manufactured exports.
Right. Things that reflect a milkman's wage or the cost of a local plumber or an office clerk's salary.
Yes, these are what he calls the much better rough and ready guide.
And what did those more accurate indexes show?
They showed the true gap was 10 or 12%.
Wow.
So the experts had watered down the severity of the required adjustment to a tiny fraction of its real size, all because they were relying on indexes dominated by raw materials. Their mistake was failing to see the huge disparity between the price of internationally traded commodities and the prices of non-internationally traded goods, labor, and services. The necessary internal deflation was 4 times larger than they admitted.
This single mistake, just misinterpreting the data, made the government believe they were making a gentle economic correction when in fact they were unleashing a storm. And that storm had catastrophic financial consequences beyond just the export competition. Let's talk about the massive wealth transfer this caused.
Yes, this is where the social injustice of it all becomes financially quantified. I mean, raising the value of sterling by 10% wasn't some neutral technical adjustment. It was a massive, involuntary, and instantaneous transfer of wealth from the productive economy, so labor and manufacturing, to the passive income classes.
The people who hold fixed income assets, we're talking about the rentiers.
Yes, exactly. The rentiers are those who receive fixed interest payments, often from bonds or mortgages. If the value of the currency they are paid in suddenly increases by 10%, the real purchasing power of their fixed payment also increases by 10%.
And Keynes calculated this, right?
He did. He calculated that this action transferred about £1 billion into the pockets of these fixed income recipients.
£1 billion in 1925. That is just an astronomical figure. I mean, to put that in context for you, the entire national expenditure of the United Kingdom that year was only about £800 million.
So this single monetary decision transferred wealth equivalent to more than a year's total government spending.
From the productive sector into the hands of wealthy bondholders.
It's a staggering redistribution. And the other side of that coin was the increased burden of debt. The government's own debt, the national debt, was fixed in sterling. By raising the pound's value, Churchill simultaneously increased the real burden of that debt by some £750 million.
So all the taxes being paid by the public to reduce the national debt, the sinking fund, were basically canceled out by the stroke of a pen.
Correct. Keynes says this policy wiped out the benefit of all our laborious contributions to the sinking fund since the war. It penalized the taxpayer and the working class while rewarding those who just held bonds. It made any subsequent argument for shared economic sacrifice completely untenable, politically and ethically.
Okay, so now we have an economy stuck in this severe disequilibrium. We have a 10% overvalued currency, and we have a massive adverse wealth transfer. Now, because the overvalued exchange makes British goods expensive abroad and makes foreign imports cheaper, the UK inevitably faced an adverse balance of trade. Gold must flow out. So how did the Bank of England react to stop that bleeding?
Well, they had to stabilize the ship immediately. They had to buy time for the so-called fundamental adjustments. So they used what Keynes calls temporary expedients to attract foreign capital and stop domestic capital from fleeing.
So what were these immediate defensive remedies?
The first and most restrictive was an embargo on foreign loans and later on colonial loans as well. Basically, we start lending our money abroad. We lock capital inside Britain to prevent sterling from being exchanged for foreign currency to buy foreign assets.
And the second remedy was using interest rates to pull money in.
Yes. They maintain what he called an unprecedented situation of keeping the London bill rate, that's the short-term interest rate, significantly higher, often a full 1% higher than in New York. This high interest rate acts like a magnet, pulling in short-term American capital, or hot money, to London.
This sounds like a very short-term patch, just ensuring enough international capital flows in to offset the negative trade balance that the overvalued currency created. They're borrowing confidence.
They're borrowing a breathing space, is how Keynes puts it. He notes the governor of the Bank of England, by paying this high rate of interest, can borrow whatever quantity of gold it may amuse him to publish in his weekly return.
So he can mask the fundamental trade deficit by constantly pulling in this short-term financial capital.
Right. But these fixes, they don't solve the core problem, that 10% misalignment of internal values.
And this is vital. The orthodox policy of the Gold Party demanded fundamental adjustments. The Bank of England disliked using these stopgap measures, but they accepted them as a temporary shield while they used the only permanent tool they had to force those internal costs down.
And that tool, Keynes insists, is one thing and one thing only: credit restriction. Dear money. The deliberate tightening of the money supply.
Which brings us to Section 4, intensifying unemployment, the horrifying social cost. If credit restriction is the tool, what is the object it's designed to achieve?
Keynes really forces us to strip away the euphemisms here. When politicians and bankers talk about fundamental adjustments, what does it mean in plain language? It means, he answers, a policy of forcing down money wages and the cost of living to the necessary extent.
So the mechanism for curing the 10% overvaluation is a deliberate, orchestrated economic attack on employment and workers' incomes.
Absolutely. The Bank of England doesn't have the power to directly dictate wages or prices. The only lever they control is the supply and cost of credit. So the object of credit restriction, of making money dear, is simply to withdraw from employers the financial means to employ labor at the existing level of prices and wages.
By constricting credit, you starve businesses of the money they need to finance their current operations, which forces them to do two things: cut production and cut staff.
Exactly. The policy aims to intentionally increase unemployment. Keynes argues that the object of this restriction is to intensify unemployment without limit until the workers are ready to accept the necessary reduction of money wages under the pressure of hard facts.
The policy is designed to create misery as a lever for deflation.
Yes. The ultimate goal is to generate so much economic pressure, so much unemployment, that workers are forced to concede the necessary 10% wage cut out of sheer desperation.
That is just a staggering thing to attribute to a government's policy: the deliberate weaponization of unemployment to meet a numerical target, a monetary goal.
And Keynes says that this is a hateful and disastrous way to conduct policy. And why? Because there is no clean, simultaneous, and generalized machinery for a 10% reduction in all wages and costs across the board.
Right. If the government could just decree a 10% cut for everyone tomorrow, it would at least be politically easier and socially fair, because the burden would be shared.
But because they're using the slow, blunt instrument of credit restriction, they're forced to fight individual battles.
They are engaging in a struggle with each separate group in turn.
And that transforms the economic adjustment into a deliberate policy of class war. The working classes, especially those in the export industries, they're the first and the hardest hit. Their standard of life drops immediately because their employers are facing bankruptcy and demanding wage cuts, but they have no guarantee that the cost of living will fall quickly enough to compensate.
So workers are completely justified in defending themselves against these cuts, because they're being asked to take a real drop in their standard of living based on a promise of future theoretical cost reductions that may or may not ever happen.
They are absolutely justified in defending themselves, Keynes argues. The result has to be industrial war until those who are economically weakest are beaten to the ground. And what's more, this method of economic pressure hits the weakest industries hardest, where wages are often already low, which just increases the existing economic disparities.
History confirms his prediction perfectly here. This policy didn't lead to a smooth adjustment. It led directly to the general strike of 1926, which was kicked off primarily by the crisis in the coal industry. Let's spend a minute on the fate of the first victim.
The coal industry is picked out above all others as the immediate and most tragic victim of our monetary policy. Coal was a vast, heavy export industry, entirely dependent on maintaining competitive sterling prices abroad.
So when the pound was overvalued by 10%, the colliery owners faced this sudden, insurmountable structural loss.
They couldn't absorb it. Their immediate solution: transfer the entire burden onto the miners.
Of course.
They proposed reducing miners' wages drastically and entirely irrespective of any change in the cost of living. This was a clear lowering in the standard of life of the miners. And unlike workers in, say, manufacturing centers who might have some theoretical ability to move jobs or cities, the miners lacked what Keynes called effective mobility of labor. They were tied to specific, geographically isolated pits.
So they were caught in this brutal trap. A trap created not by bad management or inefficiency in the pits, but by a decision made hundreds of miles away in Whitehall.
They were offered a choice, as Keynes summarized it, between starvation and submission. They were being asked to sacrifice their hard-won standard of living to deal with circumstances for which they were in no way responsible and over which they had absolutely no control.
It's just a perfect illustration of the fundamental cruelty of this policy mechanism. The political class targeted the weakest link in the chain to enforce a universal adjustment. It was the human cost of bridging that gap between 440 and the sacred 486.
And this brings us to the incredible political necessity that has to accompany a policy like this: the political lie.
Right. If the government is deliberately intensifying unemployment and industrial strife to force wage cuts, they cannot possibly admit that to the public.
Absolutely not. And this becomes a political tragedy compounding the economic one. Ministers must, Keynes writes, ascribe what is happening to every conceivable cause except the true one.
So the subsequent economic depression and all the accompanying strife, the lockouts and the strikes, that all has to be blamed on everything else.
Everything else. They would blame industrial disputes themselves or external global events or structural inefficiency in the industries.
Right.
They blame the Dawes scheme, problems in China, the instability of European markets, or, and he's being satirical here, even the shifting currents of the Gulf Stream.
Anything.
Yeah.
Literally anything, but the misguided monetary policy that set the whole deflationary juggernaut in motion.
Keynes judges that it might take up to 2 years before it would be safe for ministers to utter in public one single word of truth about the policy's role.
That 2-year window is key, isn't it? By then, either the fundamental adjustments, the widespread wage cuts, will have been forced through, or, conveniently, the ministers responsible will be out of office, and their successors can clean up the mess.
It's a profound critique of political honesty and transparency. Keynes believes the country would never permit this policy if it truly knew what was being done. The Bank of England works with such secrecy and such concealment of important statistics that it's difficult for the public to know exactly what mechanism they're using. But the use of credit restriction to force down wages is the only logical next step from the misguided position the government had adopted.
So the tragedy here is twofold. The policy is economically destructive, and it requires a veil of deception to function politically. Okay, let's move to Section V and look at the philosophy that was underpinning all of this, the fetish of gold and the juggernaut. What is the fundamental ethical split that Keynes sees here?
Keynes frames this as a struggle between two competing theories of economic governance. The first theory, which he obviously favors, believes that wages and costs should be settled by reference to what is fair and reasonable between classes with the aim of social stability.
And the second theory?
The second theory, the one driving Churchill's government, is the theory of the economic juggernaut.
The juggernaut, an unstoppable, crushing force.
Exactly. This theory holds that wages should only be settled by economic pressure, or what they would euphemistically call hard facts. It's the doctrine of strict laissez-faire applied ruthlessly to the labor market, enforced by the mechanism of gold.
And the gold standard is the perfect embodiment of this.
It's the perfect embodiment. with its dependence on pure chance, like gold flows from South Africa, its inflexible faith in automatic adjustments, and its general regardlessness of social detail. It is the emblem of this philosophy.
It sounds like the perfect system for the wealthy to manage the economy, because they're structurally insulated from the inevitable social fallout.
Keynes says it is the essential emblem and idol of those who sit in the top tier of the machine. For them, the gold standard is perfect because it guarantees the value of their fixed assets, their bonds, their rentier income, while shifting the entire burden of adjustment onto the shoulders of those who have the least power to resist. The machine just has to crash along without any attention to the consequences for individual groups or industries.
This philosophical difference is so critical. The political class, in their vague optimism, they often believe that nothing truly serious will ever happen, that they'll only cause a little distress, that the economy will soon smooth over.
But, as Keynes warns, they run a grave risk of the 10th time, where the consequences are catastrophic and lead to widespread national conflict. They are sacrificing the real welfare and social income of the nation for the sake of currency prestige, forcing a great loss of social income and severe social injustice.
The goal, monetary fidelity to the past, simply doesn't justify the means.
Not at all. The means being the deliberate creation of unemployment and the destruction of the domestic labor standard.
So if the monetary policy is the real source of all the industrial troubles, what is Keynes's proposed remedy? He starts with the most straightforward advice.
His clearest advice is also the most politically impossible: reversal of the policy. Just admit the mistake, immediately unpeg the pound from the pre-war parity, and find a new, stable rate that actually reflects the true 1925 internal cost structure.
But since we know that's politically untenable, Churchill would never admit such an immediate catastrophic error. Keynes offers some alternatives that are, better than others, rather than just letting the juggernaut roll.
Right. So he first addresses the sound but heartless policy, which is to just pursue vigorous credit restriction until the adjustments happen, knowing it will leave much injustice behind it. And that's the path the government was already on.
So what's the better route, the more ethical route?
It involves candor and collaboration. It involves moving away from secrecy and deception. Keynes suggests that the Prime Minister, Stanley Baldwin, has to face the facts frankly and sincerely and work with the trade union leaders. The ministers have to stop pretending that the wage reduction movement has nothing to do with the value of money.
They have to dismantle the political lie.
Exactly. They need to admit that the problem isn't industrial inefficiency or lazy workers, but a primarily monetary error committed by the government itself.
And once they admit that,
Once they admit they've artificially raised the value of sterling by 10%, they can approach the labor leaders and say, this is not an attack on real wages. They can explain that money wages have to fall 10% to balance the books, but they must guarantee that when the adjustment is complete, the cost of living will also fall 10%. This ensures there will have been no serious fall in real wages.
the key is that the reduction has to be achieved through agreement and shared burden, rather than through economic pressure, and to intensify unemployment until wages are forced down.
Which Keynes repeatedly calls the hateful and disastrous way. He even floats the idea of an initial uniform 5% reduction across the entire range of employment, including government and municipal work made strictly conditional on a subsequent fall in the cost of living index.
And that would ensure the cut is seen as temporary and universally applied. But to make this truly fair, they'd still need to address the fixed income class to ensure the stronger groups don't benefit unfairly at the expense of the weaker.
This is where he injects a crucial element of social equity. He knows the trade union leaders will inevitably ask what will be done about money payments other than wages, rents, profits, and interest.
Right.
The government has to have a real answer. While rents and profits might eventually fall with domestic prices, interest on bonds, especially the massive fixed interest payments on the national debt, that stays fixed. That's where the windfall profit of deflation is most deeply embedded for the rentier class.
And since that fixed interest payment is gained entirely at the expense of the rest of the community during a deflation, the government must intervene to balance the cost.
To counteract this profound injustice, Keynes offers a rough-and-ready expedient for balancing the books, levying an additional income tax of 1 shilling in the pound on all income derived from sources other than employment.
And this tax would continue until real wages had recovered to their previous pre-policy level.
Exactly. That would, at least temporarily, claw back some of that windfall profit created by the government's own deflationary action, providing a necessary measure of fairness that would make a collaborative wage reduction politically palatable.
It would establish equity and address the inherent wealth transfer caused by deliberately raising the value of money.
But ultimately, Keynes concludes that the policy they actually adopted, relying on the cruel, slow grinding of unemployment, was a hateful and disastrous way, a policy the country would never permit if it understood the underlying mechanism, nor should it.
So, to synthesize our deep dive into the economic consequences of Mr. Churchill, we saw two great figures collide over a single number, $4.86. Churchill pursued convention and prestige, guided by experts who looked at the wrong indexes, wholesale commodities, and completely underestimated the required deflationary gap, mistaking 10% for 2%.
And that decision had instantaneous and severe consequences. It crippled the nation's vital export industries. It initiated a massive wealth transfer of over £1 billion to fixed-income rentiers. And it forced the Bank of England to pursue aggressive credit restriction. Dear money.
And that restriction was just the euphemistic way of saying the government was committed to deliberately intensifying unemployment and industrial strife, a predictable class war, to compel workers, starting most tragically with the miners, to accept a 10% wage reduction to rebalance the economy.
And Keynes saw the policy as a moral failure, driven by an outdated and insensitive philosophy. The entire policy rested on the economic juggernaut theory, sacrificing social welfare and productive capacity for monetary fidelity to the past. His work here isn't just economic critique. It's a profound ethical challenge to a political class that was willing to use mass unemployment as a tool of currency management.
So what does this all mean for you, the listener? This crisis that Keynes meticulously documented, it demonstrates the profound danger when monetary policy is guided by convention and prestige, the fetish of gold, rather than being moored to empirical, real-world economic conditions and, crucially, social equity.
It illustrates that large-scale macroeconomic decisions are always ethical decisions, because the burden of adjustment is never, ever equally distributed. The question is always, which social group is the government asking to pay the price for its policy? In 1925, Keynes saw clearly that the price was being extracted from the weakest elements of the productive economy, paving the way for the general strike and the painful decade of deflation that followed.
Now, for a final provocative thought for you to mull over. Keynes noted that the political class was gambling on one key factor that might have saved them from the worst of the social cost. That high gold prices in the United States would rise, effectively doing the adjustment for Britain by making British exports cheaper relative to U.S. goods. They were betting on American inflation to save British deflation. If they gambled correctly, the social cost would be mitigated. Given what we know now about the slow, painful deflation and unparalleled industrial strife that followed in Britain, what price ultimately did the UK pay for Churchill's monetary fidelity to the pre-war past, and what does that tell us about the ethics of basing national policy on the hope of foreign economic rescue?
That intersection between political hope and economic reality is a powerful and enduring lesson.
That was the deep dive. We'll see you next time.